Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com.
Welcome back, Washington, D.C. Metro, to Real Estate 360 Live. I'm your host, Ryan Sloper, joined today by my guest, Louis Cammarosano, the General Manager of HomeGain. Quick reminder, Real Estate 360 is designed to build the Washington, D.C. Metro's housing and credit markets one house at a time. If you ever have any concerns, questions, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030, or via the web at realestate360live.com. That's realestate360live.com. It's time to jump into this week's market movers. We'll let you know what can take place on the economic calendar that can affect interest rates, and obviously your decision to when you choose to buy a home. This segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. Go to HomeGain.com today to see what I'm talking about. All you have to do is type in your home's address, and you'll get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free. So check that out today when you get a chance at HomeGain.com. So obviously we had the employment numbers that came out last week, Louis. We also had this morning U.S. retail sales, which rose 1.1%, which was supposedly boosted by the higher gas prices and electronic sales, is what was stated by the government, at least. I wouldn't read too much into that obviously the small rise in retail sales there. I would attribute most of it probably to energy prices, gas prices, and probably rising food costs as well. The bond and mortgage markets have been continuing to trade in a very tight range. I know initially when Bernanke and the Fed came out and introduced QE3, we had a pretty substantial reduction in rates. That was great. I mean, everybody was able to benefit from that. But since then, I know that they felt like it was going to probably keep rates low or have rates go lower, but it hasn't. It's actually I've seen most of the mortgage market and interest rates be more tied to what's going on in the stock market every day. Now, the stock market has been rallying for some time. It was actually, it was up again this morning. Thus, mortgage interest rates are pretty much staying unchanged. And anybody that thinks that just because the Fed is going to continue to pump in $40 billion a month for mortgage-backed securities, that interest rates, they just have to keep declining, that's just not the case. I know many people feel like, well, hey, the Fed keeps saying their whole goal is to keep interest rates low, and they're going to continue to buy mortgage-backed securities. But that doesn't necessarily mean that that's what's going to happen. As I've stated before, it gets to a certain point where it doesn't make sense for banks to lend money, and I think we're at that critical level right now, where if you're hoping for another eighth or another quarter, could it happen? Yes. Is it likely to? Probably not. And as I've stated numerous times on this show, I feel like, any time that you're trying to figure out when is the best time to buy and you're trying to time the market perfectly, it's just not going to happen. Nobody has the crystal ball that can sit here and say, okay, well, we have this report coming out on Tuesday, Wednesday, Thursday. If it comes in, positively or negative, interest rates could go up or down. I'm going to time it on that day. You don't know how the news is going to be reported. For instance, the unemployment number. I mean, that came out and it was, a lot lower than what many analysts had expected. So obviously that was going to give a boost to the stock market and had interest rates a little worse on that day. Now, many people might have thought, hey, well, I can definitely tell you that the unemployment rate is going to come back higher. So I say that because, these statistics and events that are on the economic calendar of what's reported, whether it's retail sales or an employment situation or inflation, all these things, they hold a lot of weight as to what mortgage interest rates are going to be for that day, but you just don't know how they're going to be reported. And I think that the smart thing to do is to, just look at where you're at today. Are you happy with where interest rates are today, and make that decision? I mean, if you want to float your interest rate, hoping you can get a better one, have at it. But I would say that it's a lot more risk for you to do that than just locking yourself in now to what are already like historically low interest rates. I know many people out there are always, feeling like they're trying to get the best deal, but interest rates in the 3% range, obviously depending upon your qualifications, is phenomenal. Louis, you and I have talked over and over. I mean, I honestly cannot believe that interest rates are at the levels that they're at now. And the only reason I feel that they are here is because of the continuous artificial manipulation of the interest rates by the Fed. How long will this party, continue? I don't know. But if the Fed has its way, it'll continue for the next 2 or 3 years. Do you agree with that?
I think it's a very good analysis, Ryan. I think the party may continue for a while, but it won't get much better because the rates can't go much lower. They're already very low. They can only go slightly higher, moderately higher, or much higher. So you point out, you're better off just, you can float it and you can try to pick up a quarter of a point, but you're better off getting a 30-year long-term mortgage, and if it really turns downward, you can refinance.
Yeah, and with all of the the unknowns with the fiscal cliff that we're heading towards,
with the physical cliff of the fiscal cliff.
Yeah,
it's really high.
It's astronomical, and Bernanke has recently been defending himself against the international criticism. Many of them have criticized him about the continued quantitative easing that keeps taking place, saying, that it's distorting the currency markets and capital flows in these emerging economies. One in particular, Guido Mantega of Brazil's finance minister, has been particularly critical of the Fed, alleging that it has contributed to a monetary tsunami that is hindering growth. Obviously, Bernanke is saying that that's just not the case. That's not what's going on here, and it's actually helping businesses in the import-export market. But I feel that with the tampering of these markets, your monetary policy has a lot to do with what's going on around the world right now.
Of course, and what he says, remember what he said about savers complaining about low interest rates being, hurt as a result, they can't save. And he gave an answer about, people are, we've got a lot to worry about, and there's a lot of other considerations. Basically, like, you don't really have a problem. Oh, and by the way, many savers are also homeowners. So this is going to help you. So you should really not worry about what I'm doing, because I know everything that needs to get done will get done. I'm the central planner, so be quiet. And he did the same thing with the concept of the currency appreciation of the foreign countries that were complaining. He's basically saying, oh, well, we're not really driving capital inflows into your markets. And by the way, that's not a bad thing for you anyway. You should expect some kind of currency appreciation. So basically, he kind of says that don't worry about what's happening because it's not happening. And by the way, if it's happening, it's not a problem anyway because I did it.
Yeah, and I mean, the Fed has been, the culprit of many asset bubbles. I mean, when Greenspan was in office.
No, never.
And if we remember specifically when Greenspan was in office, he kept interest rates low for an extended period of time, and we had the housing crisis, the housing bubble.
It had nothing to do with him, though.
Right, nothing to do with him. And then
They complain that they say, "Oh, that's not fair." We had housing bubbles elsewhere where they didn't have low interest rates.
Right. Now we have low interest rates again, where basically banks are hoarding money on their balance sheets, not really doing anything with it, not lending it like everybody is led to believe, and we're having basically these asset price bubbles in the stock market all over again. So that's the next thing that's probably due to crash. And
it won't be their fault. It'll be someone else's fault, and they'll continue to do what they always do, which is try to lower interest rates and print up money.
Right, which is just not sound, principles of how you're supposed to run the economy.
Well, and no one's supposed to run the economy in the first place.
but since they are, you know what I mean? Right. I mean, it's ultimately that's what we've got.
They're not running the economy; they're running the Federal Reserve for the benefits of the bank.
Correct. Yep.
That's where the problem is.
And Congress has given them basically, all power at this point, and it's
Right.
just it's it's devastating to see us go on this downward spiral. We are a real estate show here, and we tell you, okay, well, since they are doing that, how can I take advantage of that? And the way you take advantage of it is to be able to lock yourself into low fixed rate mortgages. Now, many of you are going to say, well, I've tried. I'm upside down in my house, and I'm not able to take advantage of it. I've referenced many times on other shows that, if you can, to find a way to be able to borrow that money from your 401k or from a stock portfolio, or if you can get a gift from a family member, whatever it may be, so that you can take advantage of the interest rates, especially if you're in that 5 to 6% range and you can get down into the 3% level. It makes sense to do that because you're protecting yourself. You're protecting your cost of shelter for your housing costs for the next 30 plus years. So anything that you can do to try to find a way to be able to refinance, do that. Now, I know many of you don't even have those things at your disposal, so you're like, well, what do I do now? If you're not able to make your payments, it's one thing. If you're able to make your payments and you're just unhappy with your rate, there's not much you're going to be able to do. Unfortunately, all the government programs that are out there, very few people actually are going to fit the mold to be able to do anything. But those of you that do have mortgages that are backed by Fannie Mae or Freddie Mac, you do have options. But specifically, it has to be owned by Fannie Mae or Freddie Mac. That's probably, I'd say close to 50% of the people. But the other 50% of the people, I don't want to necessarily say you're screwed, but your chances of being able to do something are probably slim to none. And in that case, that you're unable to make your mortgage payments, and you were unsuccessful getting a loan modification, and now all of a sudden you're behind on your mortgage, and you're getting basically letters from your bank saying if you don't bring this current. The best thing that you can do is to try to eliminate what's coming down the pike, which is ultimately foreclosure. You don't want it to get that far, and you can work on getting a short sale done. And I advocate this all the time because it's a win-win situation, not just for you, but it is for the bank. I believe that Realty Track had just came out with their foreclosures numbers, and it's been the lowest level. Foreclosure activity has been at the lowest level in 5 years. But yet, obviously there's still some severe problems that continue in some states. Let's see, foreclosure activity, this is according to Realty Track. Foreclosure activity nationwide fell to the lowest level in September since almost the beginning of the foreclosure crisis, which was reported on October 11th. Foreclosure filings fell 7% from the August level to a total of 180,427, or 1 in every 730 housing units. The total is 16% below the filings in September of 2011 and the lowest since July of 2007. Now, if we just look at those numbers, Louis, and we just say, okay, well, great, foreclosures at the lowest level in 5 years, we must be turning the corner. Well, it's not necessarily the case because a lot of the people that are behind on their mortgage or defaulting are opting to do short sales, which so they no longer count as foreclosures anymore.
Right.
So, it's giving you kind of a false sense of what's going on once again. There's still many people that are defaulting on their loans. There's still 1 in 3 homeowners that are underwater. But the smartest thing that you can do is to take a proactive approach and consider short selling. It's 877-245-2030. 877-245-2030. When we come back, J.P. Morgan reports a record quarter. In part, a lot of it has to do with the mortgage market. And I'll explain more when we come back. Stay right there.